Hi everyone, happy greetings from sunny Switzerland during the summertime. And I've just been given the green light from the FX Street team to start, so let's get started. There's quite a lot of good information to go through today on this one day, one subject webinar organized by FX Street on timing. And my start today is my contribution to the one day, one topic FX Street choice of timing is a subject I've specialized in for many years now, the cyclical nature of market. And that's the title of our webinar today. For those of you that wish to maybe follow up with questions after the session, if we don't have enough time to explore all of the points now, my email address, new email address is ronwilliampr@gmail.com. Also, feel free to check my recently newly launched website, ronwilliam.com, and various messages that I might send out on Twitter. That's rwilliam77. That's my Twitter account. And of course, you can also connect with me on LinkedIn and read my ad hoc comments on the blog at forexstreet.net. Okay, so that's just a quick kind of contact information overview. Okay. So a little bit about myself and my methodologies. For well over 13 years now, I've been officially in the market. Humble experience within the market, but probably one of the biggest lessons to any success that I may have achieved is having had the honor and pleasure of working with many wise mentors in the industry. And I have to say that learning from a lot of good mentors in the industry has definitely brought me where I am today, along with, of course, a lot of my hard work. Now, the area that I have focused on the most during those years has been market timing, and it's certainly one of the edges that I have as a strategist, trader, and in terms of all the trainings I do. I do focus on market timing and the advantages of market timing. And the way that I try and leverage market timing is through understanding cycles, primarily. That's my bread and butter type of analysis, where I basically try and develop a roadmap as if you were driving in a car and you wanted to learn how to get from point A to point B. Best way to do that efficiently is by using a map. And so that every single day, every single week and month, I try and identify what the map might be for the financial market that we trade. Now, for timing purposes, in terms of kind of entry and exit of my trades, I do focus on more short-term types of analysis, such as Japanese candlestick trade setups. That's a specialization of mine, and also proprietary indicators, including the works of Tom DeMark indicators, and that mainly focuses on reversal points or exhaustion points within the market. Essentially, all of these techniques that I'm talking to you about are actually quite useful for volatile markets, especially the likes of which we've seen since the financial crisis of 2007. During volatile periods, it is really important to have some kind of timing edge and, of course, focus on risk and money management, which I'll talk about in a little bit. But keep in mind the webinar today is on cycles, and certainly I would commend cycles to you in terms of giving you that perspective and also giving you that edge during volatile markets. Now, this is where I'm actually hosting this webinar from today, from my humble apartment in Switzerland, in the French region of Switzerland. So this is just a quick picture I took yesterday during the summer season, so I just want to share that with you. And it's a beautiful picture of the small village, which is nearby one of the biggest lakes in Switzerland, so it's a very nice place to be for sailing and for hiking and whatnot, outdoor activities. And my question to each of you here, just briefly before we kick into our webinar, is where in the world are each of you from? So if you could tell me which country you're actually attending from, and whether this is your first time to attend my webinars, or if you're a repeat webinar attendee of mine. I'll just quickly go back. If you could let me know. So a few people saying US. So we have three distinguished guests from the US, South Africa, Germany, Winchester, England, where it isn't raining for once. Yeah, I heard that, Gam. The weather in England's been slightly better today. Congrats for the Olympics. South Africa, Portugal, France, Turkey, UK, and Poland. Actually, quite a few regulars here, so I'm very happy to see that. Thank you so much for continuing to attend. We also have a tropical destination, the Caribbean. Welcome to you. London again, and Japan regular. Must be a little bit late there. Slovenia, second time, and the list goes on. So thank you very much for all of you attending my webinars. I've been doing them every month now for almost 2 years for FX Street, and I'm now doing it as an independent market strategist. And each of you represent interests from around the world, and also each of you, the way I like to talk about this, bring this back to the market, is each of you have your own microscope lens for the market, and this is why I love to know where each of you are coming from the world, because it tells me something about your interest in the market and also your perspectives that might actually be developing based upon your investment trends in the country that you work in and live in. And so capital flows have no boundaries really, and so in that way it's great to kind of have that global vision in these webinars. So please feel free to kind of share your ideas and questions throughout the session. Okay, now what we're going to focus on, and I always break it down into 3 parts. I like to keep things simple. Part 1 is timing is everything, history and importance of cycles, crowd psychology, what I call the perfect cycle. Some of you might remember this from a prior presentation that I gave a few months ago on this. I've altered some points in here for today. Part 2, we'll talk about classic methodology. This is the part which I've altered some bit, just to talk to you about how you can actually learn to measure cycles if you're a first-time cycle analyst. Know your market history using indicators to measure trends and ranges. And then last but not least, part 3, key market cycles. I'm just going to quickly give you an overview on my perspective on the stock market, US dollar, gold, and I threw in Japanese yen there just after I heard Ponzi's very nice market overview, of which the Japanese yen is, I think, something that I share his opinion on, looking for a potential reversal in the Japanese yen. But on my basis, it's a long-term cycle reversal that I've been expecting for some time. Some of you who've been following my work may remember me talking about that, and I've written special reports that I can send to you should you wish to kind of read more detail about it. And then one of the last things I talk about is cycles on economic indicators as well, not just the financial market. Okay, so part 1, part 2, part 3, let's get started. And my opening slide is that kind of very famous market mantra, timing is everything. And so I like to use a picture to visualize, to really kind of stimulate your thinking. And this picture is of one of the fastest animals in the world running in the savannah. It's a cheetah or a jaguar. Both are fast animals. And so my question to all of you here, one of my follow-up interactive questions is, how do you feel, what do you think when you see this photo of this animal running in the savannah? What does it mean to you? And why do you think timing is everything in life, but also in the markets? If I could just quickly get some feedback from each of you here. So I'm just going to quickly ask each of you, if some of you could tell me, how do you feel when you're seeing this image of the animal running in the savannah? So Hans, you're going to say in quick will catch first. So this idea of speed. Harley's saying need patience to trade and then act fast. So that's a good balance between being patient and then acting and then triggering your trade potentially. Anyone else? I'll just wait for 1 or 2 points, perhaps more, and then I'll move on to the next idea. So timing is everything. In this picture of a cheetah or jaguar running in the savannah, what does it mean to you? So far we've had quick movement to catch the opportunity first. So maybe you believe that market opportunities are very fast. You need to kind of capitalize on them very quickly. But then Harley kind of counterbalances that and says you need to be patient. And then our last suggestion, Ecotech says you need to be precise accurate. Najak says that you need some agility. You need to be able to adapt. I think all of these points are really important. Last point here, catch the prey at the right moment. So it's interesting that each of you are feeding off each other now in the last comments, that although it's all about speed, it is also about patience, and it is partly about being precise, being ready. So not just jumping at the first opportunity, but jumping at the best opportunity as well. And this is probably quite critical in trading generally, especially in volatile markets. And I would say more so when you're using psychoanalysis. The great thing about psychoanalysis is it gives you an edge in knowing when something will happen and sometimes by how much. But one of the pitfalls, one of the traps of psychoanalysis is not knowing when you're wrong and jumping at the first turning point that your analysis is telling you is about to take place. But then, of course, a lot of the times you can be wrong. And so one of the traps of using psychoanalysis is not having a kind of defined process for changing your view. Because often psychoanalysis means going against the crowd at extreme points within the cycle turning. And if you're right, that's wonderful. If you're wrong, that's quite painful. So you need to have some kind of a process, a filtering process for actually knowing when you're wrong, for any kind of counter trend type analysis, such as psychoanalysis. And of course, that has to be married with risk and money management rules of your own. Okay, so I'm just going to move on to the next slide. Some of you are saying that there might be some sound issues. I'll carry on presenting and just let me know if the sound issues continue. Okay, so timing is everything, and we've picked a few good buzzwords there that explain that this is all about speed, and that's the edge that you're given when you are fast in the market, in and out for those trade opportunities in volatile markets. But then there's this balance of being patient and this wisdom of choosing the best opportunities, not necessarily all the opportunities that arise. And in terms of psychoanalysis, make sure that you have a filtered process in knowing when you're right and when you're wrong, which is married with risk and money management rules of your own. Now, one of the key reasons why any kind of market timing analysis, and specifically psychoanalysis, is so useful is because of the extreme risks that we've experienced whenever we have these market shocks, and certainly in post-2007, this is the new normal, the new reality that we're experiencing. And this is a diagram here that I'm showing you. It's a statistical diagram of probability, just showing you that that not everything is what people believed it used to be. We don't live in a efficient market environment. And so the long ends of this diagram here, you can see the left and the right tails of this distribution are much, much, much longer in this diagram. And that basically tells you that market shocks happen more often than we used to believe. And so if you can think about the 2007 financial crisis, the tech bubble, the 1987 financial crash, and so on, there's so many market shocks throughout history over the last 100 years and plus that tell us that things don't continue forever, and that there are big changes, and sometimes those changes create a whole new volatility paradigm which we have to live and trade by. Now, timing is important in life, and of course it's very important to those of us that live in Switzerland, where one of the national exports of the country is the Swiss watch. And so timing is everything, and here in Switzerland, timing is all about precision. And in our daily lives, we use time to schedule our what we do throughout the day, throughout the week, throughout our lives. But much more than that, timing many, many years ago, centuries ago, was very much part of a way of living, part of spirituality, and part of calendars that were developed at the time. And one of the most famous calendars is that of the Mayan calendar. I mean, ironically, it became more famous because of this idea that there was an end to the calendar, and that might take place on the end of December 2012. But more important than that, more important than this Armageddon speculation of the end of the world, based on this Mayan calendar myth, is the fact that the Mayan calendar was just so precise. It was based on their astronomic observations. So every single day, one of the astronomers in the Mayan kind of community would stand outside and watch the planetary movements and try and track their movement in a way that they could actually then start to document time in itself. It was a very important project. And one project that they successfully achieved, they actually were the first civilization to create a calendar that was as accurate as the modern day atomic clock. So quite an achievement for an ancient civilization many centuries ago. Now, as important as timing is, it's interesting that timing is probably the unsung hero within the market. We spend most of our time in market analysis focusing on the price axis. And so we look at patterns and trends, and as soon as these consistent observations break into a new paradigm, we start drawing our projections, and we start idealizing movements based upon previous ranges and whatnot. So we focus a lot on the price axis. How much is the market going to move by? But the million-dollar question, which is so much harder to answer in my opinion, is when. And of course, I mean, there's a reason why that is. It's much more difficult to work out when something's going to happen. But I do encourage each of you, even if it's your first time to maybe kind of think about this, ask yourself the question, how much is the market going to move by, and when is it going to happen? These are two really useful questions to ask yourself all the time. And I think the other reason why time is so important is because, I mean, a lot of us have views in the market, whether it's technical or economic or fundamental. And the best thing to ask yourself, or to ask the person that you're speaking with, is what time frame are they working on? So if we are talking about quantitative easing, when might that take effect? Even if there is a diminishing effect, as Ponzi mentioned in his previous session, how much of an effect will it have, and when, over what time frame will that effect take place? So it could be just some of these events that we've been expecting. For example, quantitative easing, or very recently, the ECB President Mario Draghi, when he was kept this kind of false hope in the market that something dramatic was going to happen and the ECB was going to come in with some very strong, constructive policy. Ask yourself the question, how long am I going to wait for this event to actually hit the market and impact my trade? And this is really important because the timing side really is everything. And it is the difference between winning or losing on your trade. So always ask yourself the question, when, as much as by how much the market will move. And so it's this relationship between price and time. Once you spend enough time actually kind of doing enough analysis on the connection between price and time, you can then work out a potential turning point or key juncture point within the market. And this is the work which W.D. Gann, a famous technical strategist of the 1930s, was very successful in. He was very successful in working out the combination between price and time, and then deriving this idea of geometry in the market. Okay. Now, of course, it's important to keep in mind that these cycles are driven by human emotion, by crowd psychology. This is what creates the cycle. And so I've titled this diagram the perfect cycle. And the perfect cycle literally has these key junctures, these key stages, these key psychological stages, which can begin with optimism, enthusiasm, exhilaration, and then peaks off at this euphoric kind of emotional state of mind where you're blindly trading the market because you're just driven by all of these profits that you've made. And certainly this is part of the herding instinct, when everyone is just basically copycatting everyone else because they're all trying to outperform each other. And at this stage, this is really part of the mania. This is what manias are made out of. This is very much the kind of exuberant state of the market, which seems to go forever. And we tend to extrapolate yesterday's trends forever, not knowing or not believing that things can change. And of course, things do change, and then they reverse just as they started. They end, and it's often a mirror symmetry. If the trend is very strong, the end is even stronger. Then we have unease, denial, pessimism, panic, and then finally capitulation. And out of capitulation, despair, comes hope, ironically. There's always this yin-yang relationship between these cycles. And then from hope to relief to optimism. Now, this should be pretty clear to everyone what I'm saying. But one of the important things I want to make here, aside from the emotions that we all go through as human beings and traders in the market around the world, it's important to keep in mind that there are two phases on this sine wave, on this perfect cycle driven by human emotion. And there are only two states. One, trending state, and two, a ranging state, a sideways, flat moment in the market. Now, the trend is either up or down, and the sideways are basically the transition. The range or the sideways environment is the transition between the trends. So it's very important to be able to tie this theoretical diagram I'm describing to you about cycles with the actual market regime, the market environment that we'll be trading. So keep in mind that during the trends on this cycle, we tend to kind of have similar views, technical analysts and economists. We tend to agree with each other more often. During the turning points, this is where we're trading against the crowd, and it's more focused on market timing, risk management, because it's quite hard to call the tops and the bottoms in the market. And of course, with these different environments, trending and ranging, there are different types of strategies that we would use, different types of trending strategies and different types of ranging strategies, which have their own indicator suite to leverage. Now, that's part one. I just want to ask if there's questions. Any questions so far? So everyone's saying that the sound is okay. Okay, so I just want to ask just quickly, what we've covered now, is anyone have any questions, or is it okay? I'll continue, but I just want to make sure that there aren't any pending questions at the moment. Everyone okay for me to continue? So we've covered timing is everything, the history and importance of cycles, crowd psychology. Okay, so I shall continue. And the sound is okay, which is good. Okay, so part two, classic methodology, know your market history, and then that point that I just ended on, using indicators to measure trends and ranges. Now, whenever I teach classic market analysis methodology, I tend to use this diagram, and it's some of you that have attended my webinar presentations over the past will remember it, and if so, then this is a great refresher. For those of you who are new, then this is hopefully something of value to you. Think of a pyramid. The top part of the pyramid is the most important part. It's the macro, micro, top-down approach that we begin from the top. And that top part is trend, or in this webinar, cycle analysis. Then we break it down into key levels. And then finally, but not least, indicators. People tend to spend most of their time looking for the best indicator in town, that holy grail, which is going to make all the money in a short space of time. It doesn't exist. But that aside, I want to make the point that it's really important to focus on the price chart first and most. And so that's why I have put trends and cycles at the top, key levels beneath, and then indicators last. Indicators should really be your last points of confirmation, second to the price action itself. Price action is what dictates your profit and loss sheet. Always remember that. Now, when we're looking at the cycles, think of long-term, medium-term, and short-term. When you're looking at key levels, of course, there are different types of key levels. And when you're thinking of indicators, one thing I'll say to tie in this webinar is think of indicators that help you understand trending environments and ranging environments. Keep in mind that cycle analogy that I spoke to you about during the stage of a sine wave cycle. Now, what this means to you, if you're a trader or intraday or multi-day, is using different types of charts, using multiple charts. Never only use one chart. So I always like to use at least 3 different time frames in my analysis. For the intraday timer trader out of you, I would say the popular ones tend to be 15 to 30 minutes, 60, 120 to 40 minutes, and then finally, always important to have a daily chart. with a history of about 6 to 12 months. Now, can any of you tell me what each of these time frames mean? Why use a 15-minute time frame? What are the benefits of using a 15-minute, 30-minute time frame, and what are the benefits of using a daily chart? Why do I say that? So I just want to quickly make sure that we're all on the same page here. Why use a 15, 30-minute time frame, and why use a daily chart? So maybe each of you tell me what time frames you use on the intraday basis, and why. What purposes do you use it for? So if I can just open this question out to everyone here, what time frames do you use and why? What time frames do you use and why? So Greg says 15 and 30 minutes for entries. Harley saying daily for trend, very good point. Sanjay saying 15 minutes for intraday bias and daily for long term. Carlos is saying smaller to trade. Yep. So the small time frame is better to trade. Let me maximize this, everyone can read. 5 months and 5 minutes, 30 minutes for intraday, 1 hour daily setup trend. Jane is saying 15 minute, 1 hour, 4 hour, 1 day. Gam saying something similar. So we're getting quite a lot of responses here. English is saying higher time frame provides order flow, smaller time frame provides entry for risk management. What an amazing amount of information and useful, valuable tips that each of you are sharing with each other. This alone is a great kind of exchange of ideas, and I encourage it. But it's interesting for each of you to kind of look at the chat now and just see what type of time frames everyone's using. Emmanuel saying he uses the daily chart and hourly. So a lot of you do use intraday, and that's not surprising, of course, for your timing and for your trade tactics, entry and exit. But I'm pleased to see that people are saying that they do look at the daily chart as well as the intraday chart. I really encourage using the daily chart as well as the intraday charts. I think most people are kind of use intraday charts by default. They choose to do it, but I don't see as many people as excited at the daily and the weekly chart, just because it's not the time frames that they trade. But keep in mind that the medium term and longer term trends always affect you. Okay, so I've left it up there so you can watch the replay and see what each of you are using for time frames. And I'm just going to switch back to the diagram. Okay, so intra short term, I said 15, 30 minutes, you choose, and then either 60, 120, 240 minutes, and then finally, most importantly, daily, 6 to 12 months. I actually use all of these different time frames, so my charts tend to be a bit messy in the sense that I have, a grid of charts with a 15, with a 30 minute, and then all the other time frames that I mentioned. Keep in mind that the intraday, the minute charts are great for timing, trade tactics, entry and exit points. Daily time frame is really important to understand the trend, but also to understand maybe economic events, see how the market opened, see how the market closed, because it really offers a lot of information on sentiment and liquidity flows. So daily time frames are very important, even if you're an intraday trader. I'd say especially if you are. Now, medium term to long term, the 3 cycles that I would suggest, of course, your daily chart, 6 to 12 months, weekly, 3 to 5 years, and monthly chart, 5 to 10 years, and in some cases, I like to use 20 years, if not more. The more history, the better. But this idea of having this multiple cycle overlay of time in whatever market you look at, keep in mind what I just showed you here. So medium term to long term, daily chart, 6 to 12 month history, weekly chart, 3 to 5 years, and monthly, 5 to 10 years. And I'll just quickly rewind back. Intra short term is the minute chart and the daily chart. Okay, so at any one time when you're placing a trade, try to have these charts up on the screen. Now, a lot of the time people will say, yeah, I look at the weekly chart, but how often do you look at the weekly chart? Yeah, I look at the daily chart, but how often do you look at the daily chart? Do you look at it every day, or do you look at it once a week? Now, most people that look at intraday charts actually sit and look at the ticker tape or the tick charts moving every single day, and sometimes they won't actually get to see the daily chart. So try not to suffer by 2 things, 2 types of health conditions that I like to talk about. Tickeritis, when you're only looking at tick price movement every single day, every single second, or long-term itis, if there is such a word. Try not to look at long-term charts too much where you're missing some of the price action. Okay, so try not to suffer from tickeritis or long-termitis. When you get trapped into one particular extreme of the time frame of the cycle, it's always nice to have a balance of these cycles, and that's why I always speak in terms of 3 key cycles: intra-short-term 3 key cycles, and medium-term, long-term 3 key cycles. Is that clear to everyone? Okay, hopefully it is. Just going to quickly see if there's any questions. Okay, so getting yes there. Thanks, Harley, for your acknowledgement. Good to know that I'm on track with the conversation. Okay, so this is what a cycle looks like. Remember, I showed it to you originally as the emotional perfect cycle of crowd psychology, but here I want to kind of really harness this idea of trends and ranges. Now, in any theoretical representation of a cycle, you will have one cycle where it dips from a prior cycle and then rises into an uptrend and then transitions. We have this kind of distribution topping phase back into a downtrend or a trending phase, a downtrend phase into a start of a new cycle. So that's what any one cycle looks like, and then you have multiple cycles of these. Now, when you have so that's the big cycle, the fat blue line, dark blue line. Then of course you have other cycles within that cycle. So you have internal cycles, and so that's why we have these intra short-term cycles and these medium-term, long-term cycles. This is what it looks like visually, and you can see here the red dotted line is your kind of medium-term cycle, and the is the short-term intra cycle, and the light turquoise line is the medium-term cycle. So you have intra, short-term, medium-term, and long-term. But the key message that I actually want to drive here, as I said, is trends and ranges. And so notice that during the turning points, you get the ranges, the transitions, range 1, range 2, range 3. And then once you break out of those ranges, you get these trending phases, either an uptrend or a downtrend. Hopefully that's clear as light to everyone. It's very simple what I'm saying, but very important what I'm saying. And so the question we must all ask ourselves, now that we know that there's only ever 2 states of regimes, environments that the market will play in, is how can we use indicators, or how can we use different types of analysis to measure these trading environments, whether it's a trending environment or whether it's a ranging environment. And so one of the best ways, one of the popular ways, is by using indicators. Now, I want to open this question to everyone. What type of indicators are good for measuring trends, and what type of indicators are good for measuring ranges? So you tell me, what type of indicators do each of you use to measure trends, and what type of indicators do each of you use for measuring ranges? So Mike is saying oscillators for ranges and momentum indicators for trends. Absolutely. So thank you for giving me kind of a very good kind of starting point there. So oscillators, for example, like the RSI, the MACD, stochastics, these are all oscillators. These are all indicators that measure range, largely measure range-bound markets. English is saying he likes to look at the CCI. Let me just try and get this chat up so you can all see it. ADX, FX is saying moving averages and MACD, so moving averages for trends, MACD for ranges. Aroma is saying stochastics for range and ADX for trend. ADX is also a great indicator for measuring trend. And then we're getting various other. Carlos is saying nothing but price action. You can, of course, use price action and just use chart patterns and trend lines just to measure the highs and the lows and the chart structure. That's perfectly fine. So great. All of you already have your own methodologies for measuring trends and ranges. So I think all of you are fine with that. Just for those of you that are looking for certain parameters for some of these indicators, for moving averages, I would suggest the 20-day moving average, the 50-day moving average, or 100, and the 200-day moving average. So 20 is your short-term moving average, 50 or 100 is your medium-term moving average, and 200-day is your long-term moving average. Everyone okay with that? So let me just quickly write that in. 20, 50, 100, or 200. They're different moving averages. And of course, you have to kind of change them accordingly. And then, yeah, your oscillators, you can pretty much use the ones that you use, and then focus on extreme movements of those oscillators and divergences of those. Okay, and this is how you can measure a cycle. So they're not just your foundation level, how do I trade in the market indicators. These indicators can be used to measure cycles and, most importantly, changes within those cycles. Here's the problem. Perception versus reality. A lot of the times when you're using any kind of market analysis, but specifically any kind of counter-trend market analysis, such as cycles, one of the biggest traps is distinguishing between what you think is going to happen and what is actually happening, what I call perception versus reality. And you can see this beautiful picture here of a cute kitten staring at herself idly in the mirror. And what does she see? She sees a roaring, courageous lion or lioness in the mirror. So this idea of perception and reality. Now, how many people have felt this before when they have a market view and, for want of a better response, they're wrong? How many of you have just had a market view and for whatever reason it's been wrong, and you felt like the lion, you felt very courageous, you really believed in that market view, but for whatever reason it proved wrong? I'm just wait for a few yeses. Some people saying too many times, everyone's several times. So I can see there a lot of people felt that way, and that's normal, whatever analysis you use. I would say that anytime you actually use counter-trend analysis, any analysis that looks for turning points in the market, this is the psychology, this is the mind game that you have to go through on a daily basis. And so the cycle analysis that I've used for years, combined with my timing tools such as Japanese candle patterns, which most of them pick turning points, and the market indicators, which are largely focusing on reversals and exhaustion points, most of the time I am going against the trend. Now, I still like to identify the trend and trade the trend, but most of the times, equally, I'm looking for the change of that trend and the reversal of that trend in some cases. And so a lot of times you really have to play these mind games with yourself, where you have to, where you have this game between what you're perceiving in your mind based upon your good research versus the reality of the market reality. And so my conclusion here is, whenever you go through this psychology, but especially when you're using counter trend or cyclical types of analysis, where by definition you're going to look for turning points at some point, always wait for confirmation from the market. Have a price and time filter, and of course marry all of your analysis with risk and money management. I cannot encourage that any more than what I'm saying at the moment. It's so critical, and it is literally the difference between winning and losing money in these markets, especially when the markets are volatile. And so some of you might have seen it in previous webinars where people are talking about trades that they've had on. For example, I had a very important trade on dollar yen, which I still believe is going to reverse to the upside, but it took a long time for that to actually take place, and it did reverse, but then of course fall back again. Some of you saw the intraday trade, which Ed Ponte was talking about on cable, on sterling dollar, on an intraday basis, and the view was and is correct in my opinion, and I agree, but then it's always being able to time that trade, which is always the big challenge. And some of you will have your own trades that you're already thinking about as well. So keep in mind this idea between perception versus reality, being the cute kitten that knows that she looks good and believes in herself or himself, but then looking in the mirror and being a little too overconfident in your view, and then not being able to change your mind in time and as fast as the market does. Remember, the market is dynamic. It is not static. There's nothing linear about the market movements. So you need to be able to adapt your market strategy with the market's changing reality. So keep in mind perception versus reality, and then it's very important when you're looking at any counter, trend, or cyclical type of analysis. Okay, now one of the ways that you can increase your wisdom in applying any type of analysis, but especially cycle analysis, is to know your history. And so here's a wonderful picture of one of the ancient wonders of the world, the pyramids of Giza in Egypt. And one of the proverbs that I coined a while ago, just a very simple one, let history navigate the future. Now, a lot of the times you'll get legal advisors, accountants, and lawyers and whatnot saying that, or financial advisors saying that, the past is not an indication of returns, future returns. That's probably true in most cases. But in terms of market analysis, history might not repeat exactly the same way. So, the past is not indicative of the future, but that there are very important observations to be learned from the past. So just keep in mind that there is so much rich information, valuable information in the past to learn from, and you can, yes, you can use that to predict the future. But of course, keep in mind that the future, there's no guarantee of what will happen in the future, and it's all based on probabilities. We don't deal in certainty, we deal in probability. So we're using the past, we're wanting to understand history in order to develop probable outcomes in the future. So the mistake that people often make is to think that, okay, based upon this analysis, this is going to happen. A equals B, 1 plus 1 equals 2. And of course, the market never really gives us that perfect equation. So keep in mind, it's not about getting it right, and it is most of the time, unfortunately, about getting it wrong. But what's important is that you understand that we never know what's going to happen for sure. We only know what is probable. And with that sense of probability, high probability strategy, we then of course marry risk and money management so that if we are wrong, we don't get it wrong too much and we don't lose too much. I hope that's clear to everyone. So know your history. You need to have the context of what happened in the past, the price behavior of the market, the key cycles, the key levels, how the indicators behaved in the past. Remember that kind of pyramid analysis I told you about, trends, key levels, and indicators. But then you also need to use that to increase the probability of forecasting the future, married with your risk and money management. Now, that's part 2 done and dusted, and now the remaining part we're going to focus on part 3, key market cycles. I'm going to talk about some macro cycle points. Then I'm just going to give you my quick market, stock market view, US dollar view, and gold view, and I've quickly thrown in Japanese yen, and then a focus on economic indicators such as US GDP. Okay, I just want to quickly do a check. How much time do I have, guys? Just get a quick, while I'm answering these questions. Mike's asking, waiting for confirmation usually shaves off 10-20% of the potential gain, but it's worth it. Absolutely right, Mike. Thank you so much for saying that. I'd much rather lose a little bit and get it and make the trade, make a successful trade, than get it wrong and lose a lot. And you really need to think about it that way. And always keep in mind that there are many trades in the market. There are many trades in the market. Unfortunately, I'm being told that there are only a few minutes left, so I'm just going to talk very fast, as Charlie just said. Thank you. Okay, very quickly, key market cycles, stock market cycles going back 100 years. Notice that there are long-term cycles which last anything from 16 to 20 years, and these are what I call generational trends. And the most recent one has been since 2000. We've been in a long-term generational trend which spans the generation of our professional career, 16 to 20 years, which is likely to end in 2016 or thereabouts. But in and around that, we're just going to have a volatile market environment. Okay, and of course the comparison to that is 1966 and 1982, and some people who are much more bearish, the 1920s, when we had a big crash. Long-term cycle on gold, I'm still hold the view that although we're having this kind of neutral consolidation period, anything below 1522 will suggest a short to medium-term cyclical reversal into 1470 and 1300. And you can probably watch me on CNBC. I have an interview tomorrow afternoon on CNBC, actually talking about some of these market calls. And finally, Japanese yen. For some time now, actually since last year, I've been talking about a 40-year cycle reversal on Japanese yen. Keep in mind that if you just look at your weekly charts, and I think that was presented in the previous webinar before mine, there's a multi-year breakout pattern which has been in the background for some time on dollar yen. That is not just dollar yen upside reversal, but there's also broad Japanese yen weakness, which I think ties in with the macro story about how yields are going to change and how that will maybe reintroduce the carry trade on this currency. Also, I think from a very long-term macro basis, it makes a big impact on Japan generally, and you might see some influence on the local stock market, the Nikkei, which has been sleeping for over 20 years. Finally, US GDP weak into the cycle lows. There's a well-known 10-year cycle, which sometimes coincides with a 4-year presidential cycle. Not only can this be used on the stock market, but it can also be used on economic indicators such as US GDP. Whenever US GDP falls below 0 for 2 consecutive quarters, that's recession. And what we find is that there is a cyclical nature to recessions when they appear. Remember the 10 and the 4-year cycle, which I alluded to. And one of the key analogies I want to make is this idea of a potential double dip recession taking place into 2013. We already had the first part of that in 2009, and because such a deep recession, where this growth period has been quite weak. I won't have any time to go over this diagram, but suffice to say, this is the roadmap which I'm working on, and 2013 is on the downside. And that's it today, guys. Enlightenment to realized knowledge. It's been an honor and a pleasure sharing these ideas with you today. And please keep in mind that my next webinar, Market Outlook for the end of the year, Q4 2012, is scheduled for Tuesday, the 11th September at 2 p.m. And please take note of my email address and website, ronwilliam.com, if you want to follow my comments, and also on Twitter, of course. Thank you very much. It's been an honor and pleasure, and please feel free to email me if you have any questions. Apologies for speeding up that last bit, but I finished in time. Thank you very much, FX Street, and I think this is recorded, so please feel free to tune in afterwards. Okay? All the best. Have a fantastic summer, and see you in September.